Most people have heard the word bailout. During the financial crisis, governments sometimes step in and rescue banks with taxpayer money. But there is another term that sounds very familiar and works very differently. It's actually called a bail-in. And unlike a bailout, where outside money is used to stabilize a bank, a bail-in uses money that's already inside the bank itself. In other words, the losses are absorbed by the people connected to the bank, investors, creditors, and sometimes even depositors. So what exactly is a bail-in? Why were these policies even created? And why do so many people confuse them with bailouts? I got an idea. Let's break it down. In 2013, people in Cyprus woke up to discover that their own bank deposits were being seized to rescue failing banks. Not taxpayer money. Their money. It was called a bail-in. And most people had never heard of it before it happened to them. Since then, governments around the world have quietly built bail-in frameworks into their banking laws. The question is, could it happen again? And if it did, would your deposits be safe? To understand the answer, you need to understand how bail-ins actually work and why they exist in the first place. Let's start with a simple question. What happens when a large bank gets into serious financial trouble? Historically, governments faced a difficult decision. If a major bank collapsed suddenly, the damage could spread through the financial system. Depositors might panic. Other banks could experience withdrawals, credit markets might freeze, and the broader economy could fall into recession. Because of that risk, governments sometimes stepped in to rescue failing banks. These rescues became known as bailouts. During a bailout, outside money, usually government funds, is used to stabilize the bank. The goal is to prevent a wider financial crisis. But bailouts created a major political and economic problem. Taxpayers ended up supporting institutions that had taken large financial risks. During the global financial crisis of 2008, this issue became extremely controversial. Several large financial institutions received government support. While those policies helped stabilize the financial system, they also sparked widespread anger. Many people felt that banks were being rescued while ordinary citizens struggled with unemployment, falling home prices, and economic uncertainty. In response to that backlash, policymakers began exploring a different approach. Instead of rescuing banks with outside money, what if failing banks could be stabilized from the inside? This idea eventually became known as a bail-in. A bail-in works very differently from a bailout. Instead of using taxpayer funds, a bail-in forces certain investors and creditors of the bank to absorb the losses. In other words, the financial burden shifts away from the public and onto the people who provided funding to the bank. To understand how this works, we need to look at how banks are structured financially. Banks are funded through several layers of capital. At the top are shareholders. These are the owners of the bank. Below shareholders are different types of debt investors, institutions that have lent money to the bank by purchasing bonds. And below that are depositors. When a bank begins experiencing severe losses, those losses move through this structure. Shareholders are typically the first to be wiped out. If the losses are larger than the bank's shareholder equity, then certain types of bondholders may also absorb losses. In a bail-in scenario, regulators can force some of those bonds to be converted into equity, essentially turning debt into ownership shares. This recapitalizes the bank. Instead of collapsing, the institution receives a new capital cushion created by converting creditor claims into stock. This allows the bank to continue operating while its financial structure is rebuilt. The idea behind bail-ins is that investors who knowingly took risks by funding the bank should bear the losses, not taxpayers. But the concept becomes more controversial when it involves depositors. In most countries, small depositors are protected through deposit insurance systems. For example, in the United States, deposits up to a certain limit are insured by the FDIC. This means that if a bank fails, insured depositors are typically protected, but deposits above that insurance limit are technically unsecured liabilities of the bank. In extreme situations... Hey, sorry to disturb you in the middle of this video, but can I ask you a question? Would you like to take advantage of this real estate downturn that's already started? If you want it, I've got an entire bundle of courses put together for one insanely low price. It teaches you real estate cycles, what to do and how to buy real estate in a bear market, how to market it, how to sell it. You're going to crush it. Links down below. Take a look at it. Now back to the video. Those large deposits could potentially become part of a bail-in process. That possibility became widely discussed after an event that occurred in 2013. During the financial crisis in Cyprus, several banks experienced severe losses tied to government debt and real estate markets. To stabilize the system, authorities implemented one of the first large-scale bail-ins in modern banking history. Shareholders were wiped out, bondholders absorbed losses, and some large depositors saw portions of their funds converted into bank equity. The decision shocked many observers, but policymakers argued that the alternative, a full government bailout, would have placed enormous strain on the country's finances. Since then, many countries have incorporated bail-in frameworks into their banking regulations. These frameworks are designed to ensure that banks can be resolved in an orderly way if they experience major financial problems. The goal is to prevent the chaotic collapses that sometimes occurred in past banking crises. However, the existence of bail-in rules has also created confusion. Many people assume that if a bank gets into trouble, their deposits could automatically disappear. But in reality, bail-ins are typically designed to affect specific categories of investors first: shareholders, certain bondholders, and other institutional creditors. Depositors within insured limits are generally protected by government insurance programs, and regulators usually try to avoid involving depositors unless losses become extremely severe. Still, the concept highlights an important shift in how policymakers think about financial crises. Before 2008, governments often relied heavily on bailouts. After 2008, policymakers began designing systems that would shift more of the burden toward investors and creditors. In other words, the goal became creating a system where financial institutions could fail, without forcing taxpayers to rescue them. Whether that system works perfectly remains an open question. Financial crises are complicated, and each crisis tends to unfold differently depending on the institutions involved and the broader economic environment. But understanding the difference between bailouts and bail-ins helps clarify an important part of modern financial regulation. A bailout uses outside money to rescue a bank. A bail-in uses the bank's own financial structure to absorb losses internally. And that difference explains why policymakers increasingly talk about bail-ins when designing financial stability policies, because when the next banking crisis eventually appears, the debate over who absorbs the losses will once again become one of the most important questions in the financial system. If you found this breakdown helpful and want more videos explaining how banking systems, financial crises, and economic policies actually work behind the scenes, consider subscribing. And if you want to go deeper into how governments manage banking crises, check out the next video on your screen, where we explain how deposit insurance works and why it plays such an important role in preventing bank runs. Understanding those systems can completely change how you think about financial stability. I'll see you in the next one.